Imagine for a moment you've invested your hard-earned money in a company. When that annual letter arrives, what are you truly hoping to find inside? Is it just a stack of numbers and dense financial jargon? Or are you looking for the real story? The heartbeat of the company, its triumphs, and maybe even its transparent struggles. Today, we're doing a deep dive into something often overlooked, but honestly incredibly rich with insight. A shareholder letter from 2003, specifically from the Markel Group. Our mission isn't just to recite facts or, revisit two-decade-old figures. We're going to try and extract the most important nuggets of knowledge and insight and explore what these documents, even from years past, can teach us about business, investing, and, the enduring power of transparency today.
Yeah, it's an excellent choice for a deep dive. 2003 was a fascinating year in the market. We were sort of emerging from that period of volatility, post-dot-com bust, and stepping into new economic dynamics. Markel's performance and, crucially, their communication style in that letter, it reveals a lot about their core philosophy, right from early on, a philosophy that's frankly proven incredibly resilient over time. It's almost a blueprint for understanding their long-term approach to value creation.
Okay, so the letter opens with this pretty bold claim, right? A very good year, record results. But how much of that was, say, genuine operational excellence versus maybe just a broader market tailwind after the bust? What were the most compelling wins Markel was really highlighting for shareholders, the things that showed their unique strength?
Absolutely. And the letter does paint a picture of exceptional financial strength that I think went beyond just market uplift. So, for example, their core insurance business saw gross written premiums jump a solid 16%. That's up to $2.6 billion. And this wasn't just top-line growth. It really translated to record net income of $123 million. But here's the real kicker, I think. Their investment returns were truly stellar. They clocked in at an impressive 31% rate of return on their equity investments that year.
Wow, 31% in 2003. That's remarkable.
Yeah.
What did that actually mean for shareholders directly?
Well, fundamentally, what this meant for shareholders was a healthy 19% increase in book value per share. It hit $140. And beyond that, overall revenues increased 18% to $2.1 billion. Their total investment portfolio, including cash, it grew 24% to $5.3 billion. So these numbers, taken together, they painted a picture of a company not just performing well, but actively compounding shareholder wealth. Shareholders' equity itself increased to $1.4 billion. The overall investment return for the year was 10.5%. Just really solid numbers across the board.
Okay, solid numbers. But what's truly fascinating, like you hinted, is that right after sharing all that good news, the letter immediately pivots to what they called disappointments, which raises a really important question. How does a company balance celebrating success with, transparently acknowledging challenges?
Exactly. They immediately highlight areas where they suffered adverse loss development, which, just to clarify, means their actual losses turned out to be higher than they had initially estimated. And this happened in 3 specific areas, resulting in charges amounting to a pretty substantial $181 million.
Whoa, $181 million. That's not a small number to just mention in passing in an annual letter.
Not at all. And they openly recognized significant loss reserve deficiencies, meaning they hadn't set aside enough money to cover claims from previous years, specifically in their brokered excess and surplus lines unit. This amounted to $91 million just for accident years, stretching from 1997 through 2001. Though, importantly, they were quick to add that the underwriting and pricing issues that led to this were resolved in 2003. They also pointed to asbestos claims, calling it an expensive issue, even though their actual market share for those pre-1986 exposures was tiny, less than 1%. And things like discontinued business and prior year development continued to be, a bit of a drag on the results.
It's almost refreshing, isn't it, to see them lay out the good and the bad so clearly side by side. But let me play devil's advocate for a second. Couldn't highlighting past problems also be a way to, say, manage expectations? Or maybe even subtly deflect from other issues happening right then? What makes you feel Markel's transparency here was truly authentic?
That's a fair question. But I think what's truly insightful here is how Markel, back in 2003, was already practicing what many companies still struggle with today. This idea that revealing your mistakes, rather than glossing over them, it isn't a sign of weakness at all. It's actually, I'd argue, an aggressive strategy for building unshakable trust. They clearly wanted shareholders to understand the full picture. the inherent risks, their commitment to addressing them, not just the rosy parts. And this kind of frank communication, well, it turns transparency itself into a kind of competitive advantage, especially in an often opaque industry like insurance. It signals a maturity, right? A value placed on truth over spin. And that's foundational for building deep trust with investors over many, many years.
Okay, so we've seen how they confronted those substantial disappointments, which brings up a critical point. How did their core insurance engine actually perform with those headwinds blowing? What was their guiding philosophy in managing risk in the very heart of their business?
Right. And this letter truly highlights Markel's core identity. It's built on two pillars: disciplined underwriting and conservative loss reserving. And despite those $181 million charges we talked about for prior period adverse development, the company still achieved a modest underwriting profit for the year overall. That's critical because it demonstrates the underlying health of the current business, the stuff they were writing then. Their company-wide combined ratio for 2003 was 99%. And for those listening, just a reminder, a combined ratio below 100% means an underwriting profit. They made more from premiums than they paid out in claims and expenses. They mentioned doing an internal claims review and stated their belief that their current business was, in their words, well-priced and underwritten. Now, digging into the segments, their specialty admitted operations were a real standout performer. Premiums there increased 15% to $271 million. Earned premiums were up 27% to $235 million. And this unit saw its combined ratio decline to a very strong 90%. That's excellent profitability. And their excess and surplus operations also performed well. Gross written premiums increased 15% over the prior year to $1.5 billion. And they noted having more opportunities to write business and at higher prices. So good momentum there, too.
So some segments were clearly thriving, hitting their targets, almost acting as a counterbalance, you could say. But what about the areas that struggled, like London? You mentioned some challenges there earlier, right? London's operations were essentially losing money on the underwriting side. Was this a common problem in the London market back then, or more of an internal Markel issue they needed to fix?
Indeed. While Markel International's London insurance market operations reported a solid $738 million in gross written premiums, that's up 19% over the prior year, they had a 104% combined ratio for the earned premiums, which were $575 million, which, as you deduced, indicates an underwriting loss in that specific unit. So yes, they were losing money on the policies written there. This was certainly a disappointment, and it wasn't necessarily a widespread market issue, more of a specific internal challenge for Markel at that time. And it prompted pretty significant management changes in 2003. Jerry Albanese moved over to London to become president and chief operating officer, and Richie Witt joined as executive vice president and chief administrative officer. This really demonstrates their willingness to address underperforming units directly, take decisive action, rather than letting problems just fester. It highlights that disciplined underwriting isn't just some accounting term. It's about making sure every policy written is expected to be profitable over its lifetime, not just chasing premium volume. And that's a core principle for long-term stability, especially in an industry prone to cycles. As they even noted in the letter, the industry had just come off 15 years of soft pricing before 2003. So discipline was key.
Okay, that makes sense. Now, an insurance company doesn't just collect premiums, right? It strategically deploys that capital to float. So beyond the underwriting, what was Markel's secret sauce, maybe, in making their money work harder? How do they approach their investment philosophy? Was it as disciplined as their insurance operations?
Oh, absolutely. Markel strongly emphasizes superior investing as crucial for building shareholder value. They explicitly state it's one of their two engines, right alongside disciplined underwriting. And in 2003, they delivered what they call truly superior investment performance. Those equity investments, as we noted, returned that impressive 31%. They calculated they added hundreds of millions to shareholders' equity just through these investment decisions. Now, the equity portfolio itself was about $551 million, or 13% of the total investment portfolio. But if you include the unrealized gains, the paper profits equity investments were actually $969 million, which represented 18% of the total portfolio, but a whopping 70% of shareholders' equity at the time. Investment income increased a healthy 7.3% to $183 million. They had net realized investment gains of $45 million, and those unrealized gains were $141 million. And they were also very strategic in their fixed income. They were actively shortening the duration of their fixed income portfolio, essentially investing in bonds that would mature sooner. Because, as they put it, they were leery of increasing interest rates, a really smart move if you expect rates to rise, because it reduces your interest rate risk. And at the same time, they were allocating more funds to equity securities while still maintaining a high-quality overall portfolio.
So it sounds like they were very actively managing their portfolio. being strategic about where they put their money, anticipating market shifts. How does this dynamic investment strategy connect to their overall business model? Using that insurance float.
Well, it raises that important question, doesn't it? How Markel balances its insurance float, those premiums collected but not yet paid out in claims, with investment risk. And their approach clearly reflects a value investing philosophy, very focused on achieving sound returns through disciplined investment, much like you see in other famous long-term compounders, perhaps like Berkshire Hathaway. They clearly see investment as a key pillar, right alongside disciplined underwriting for building long-term shareholder value. They aren't just passively holding assets, they're actively seeking opportunities to deploy capital for superior returns, which is absolutely fundamental to compounding book value over time.
Okay, so we've talked about the impressive numbers, the strategic moves in both insurance and investments. But looking back at this letter, 20 years later, what kind of culture and leadership are we really seeing reflected here? What was the company's DNA, so to speak?
Yeah, the letter gives us a fantastic window into what makes Markel, Markel. Their philosophy clearly hinges on transparency, discipline, and a really long-term outlook. They explicitly state, "We set high standards and goals for ourselves and are naturally disappointed when we fail to achieve them." Now, that might sound like corporate speak, but given the context of them laying out the disappointments, it feels genuine. It shows a culture of accountability. They even devoted a whole section to corporate governance, emphasizing a true spirit of sound corporate governance. They highlighted their independent directors by name, people like Tom Gaynor, Gary Markel, Daryl Martin, noting that the board had 7 directors and 4 were independent. And they even referenced this great quote from Barbara Mandel saying, "We were country when country wasn't cool." Kind of reflecting this independent, principled stance that they had before maybe it became fashionable or required. Their willingness to openly discuss adverse loss development and loss reserve deficiencies, as we've discussed, that builds trust. It demonstrates their belief in full and complete disclosure. They also talked about new regulations increasing bureaucracy and cost potentially $3 million back then, yet their commitment to good corporate governance remained strong. And they clearly learned from challenges, acknowledging that the insurance industry had those 15 years of soft pricing before 2003, implying a need for constant vigilance, continuous learning, aiming to make fewer mistakes.
It really sounds like they were trying to run a business built to last, for decades, not just for a single year's results or market sentiment. This wasn't just a quarterly earnings call vibe. It felt more like a conversation about building a legacy.
Exactly. And I think the broader implication here, the big takeaway, is that financial performance isn't just about the numbers on a page. It's deeply intertwined with the company's values, its commitment to critical thinking, its ability to maintain discipline in both good times and bad. This long-term orientation, this unique Markel style, it's absolutely key to understanding their consistent compounding of book value over so many years. It really is about character as much as it is about capital, fostering a culture where challenges are met head-on and learning is absolutely constant.
Wow. What an insightful deep dive into Markel's 2003 shareholder letter. We've seen a company celebrating strong performance while being, frankly, incredibly transparent about its challenges. We've seen them operating with disciplined underwriting, executing a smart, active investment strategy. And all of that underpinned by this clear cultural philosophy of accountability and long-term vision.
Yeah, and this letter isn't just some historical document gathering dust. It's really a living case study for anyone, seeking to build a resilient business. It illustrates how success isn't just about hitting the numbers, it's about the bedrock principles. Disciplined operations, smart capital allocation, and crucially, a culture that embraces both triumph and transparent self-correction. It's really about how consistently applying these principles, even through setbacks, leads to sustainable value creation over the long haul.
So what does this tell us maybe about the power of consistency and transparency, even when things aren't perfect? The power that has in building lasting value and trust with your partners, whether those partners are shareholders, customers, or even your own employees. It really leaves you with something to ponder, doesn't it? About the long game in business and investing.